Okay, there we are. I think we've clicked on live now. And if a lot of you didn't get the normal invite this week, for some reason, I got a dialogue back from Facebook suggesting that there was too much posting going on, even though I only put like one post up this week. So I'm not sure what the issue is, but they wouldn't let me send the invites out. So you would have had to have seen the announcement out of the group. So no offense to anybody who didn't get invited. I will leave this up so that you can check out the replay if you like. And I'm sure we did send something out via email as well. So if you are with me, go ahead and chime in into the comments. And if you're with me via the replay of this, feel free to leave comments and I'll come in and answer questions when I get around to it. So this is an interesting week because we started out the year really unraveling a 21 week training program, and we are in week. Hey Carol, good to have you on here. Thanks for chiming in. Gordon, how are you? Now I'm starting to see the comments. I'll peek down at the comments every now and then to make sure I'm following along with y'all. And hey, good to have you. I see you in here as well. By the way, I'm watching somebody's dog and they appear to have separation anxiety. So if you hear some chirping in the background, I might have to pick this dog up and try to put him on my lap. In fact, come over here. Coco, come here. Come here. Okay, don't then. Here, you shall sit. I got my dog here too. All right, I think they're good. I think they're all good. Lex, hey, good to have you. So, what we've done is we've gone through a robust set of strategies, followed by what our approach is to the seller, which is very consultative in nature because we can buy anybody's house in any market condition, regardless of price, regardless of the financing situation, regardless if it's over leveraged, free and clear, whatever the situation is. The only criteria for us to profit on a house and still give the seller what they want is that they're willing to sell the house. Now, what strategy we plug them into depends on how they respond to our approach and how they respond to, with questions and how they like the answers that we have. And then we can plug them into the right outlet that allows us to make money. And in that sense, we really pick and choose who we are going to work with to a certain extent. Our conversion ratio goes through the roof because we can convert any seller. It's not a matter of typical old school style real estate investing, still, fairly common today, trying to get houses at 60 cents on the dollar. It's much more difficult to do that today than it used to be. You need a more full and comprehensive set of strategies to operate optimally as a real estate investor today. So that's what we do. So we went through all that, and as you learn how to convert sellers, the conversion isn't just oral, right? You still have to be able to put agreements together. So we went through the various agreements that are needed to memorialize the deals that direct the professionals, the attorneys and the title companies, to close the sales so that we're operating within any compliance boundaries, we're operating within a certain regulatory framework, and we protect ourselves from any kind of nuance that can occur in a major real estate transaction. So we went through that, and then we went into, okay, now we know how to do the deals, now we know how to close the deals, now we know how to get paid. Well, hey, I want to do that again. So how do we scale our business up with the various types of marketing that you can deploy in order to get better quality leads and target particular areas and target particular strategies and so on and so forth. So we went through all of that. So when you put that whole mix together, you've got a framework to be very, very effective in real estate. The big missing piece, and I'm saying missing piece in all of real estate, and including the big missing piece even in what I've rolled out over, these last 20 weeks or so, is if you don't combine all of this book learning, all of this video learning with coaching and mentoring and guidance on what to do next, that GPS level guidance that's in your ear saying turn left, turn right, there's the destination, you've arrived, or don't go this way, there's traffic at this juncture, then you are, if the statistics play out, and again, I'm saying even with what I've rolled out here, if the statistics play out, most of you are going to fail and fail miserably. And that's not an assault on anybody's personal competency, character, skill sets. What it is, it's just a fact that 95% of people will fail in real estate investing if they don't have the proper guidance and proper coaching that can only come from a coach. It does not come from getting to know me via videos or via Facebook Lives. Now, having said that, there's a couple thousand people in this group. That means 5% of the people will be wildly successful because these strategies lead to being wildly successful. And that's, a fair amount of people. That's over 100 people that are, probably going to produce 7 figures of income and wealth, maybe in the next 12 to 18 months using these strategies. So I think it's a worthwhile venture. Also, it's good to sort of lay the foundation for folks who aren't sure if they want to get into real estate or not. Now you have an idea of what it takes. The next best move, if you're attracted to, seeing the kind of money that we can make, is to get on a discovery call with me. It will be with me personally, and determine if this is a good fit for you. If the coaching that I can deliver to you is something that we both feel makes sense. So again, I'm just making the recommendation that it's good to get this knowledge in your brain, but without help, it's really, really hard to make this stuff work for you. And I can't think of a better place of where you can get help than through my coaching program. But I'm not the only one. So what I'm suggesting is don't stop with just the videos. Get some kind of coaching or get on some calls. There's various folks who offer it. I don't take everybody in, but we can at least have an introductory call, and I can direct you somewhere if we end up not being the right fit. Now, having said that, that brings us to kind of an interesting milestone in the program, which is I've showed you how to make all of this money. What do you do when you actually get the money? And much to a lot of folks' surprise, hey Katrina, much to a lot of people's surprise, generally the cash profits that I receive do not get put into real estate. Why? Well, the reason for that is I can get as much real estate as I want anytime I want and build cash immediately, build cash flow, and build paper wealth, meaning the difference between the value of the property and what I'm effectively paying for it. I can do that anytime, anywhere, without using any of my own money or any of my own credit, because I have the skills in my brain, and I'm able to take those skills and deploy them in the market and produce top line revenue that way. That's the most important way of making money. It is not taking your cash profits and expecting that to make money for you. It's a fair expectation to have, and it's something that we should do, and it's actually the topic of today's live. But where you ought to be focused, if you don't have at least $1 million, you ought to be focused on skill development. And I can tell you right now, if you do what I've told you to do over these 20 weeks and you combine it with coaching at the pathetically low price that I charge for this coaching, there's no reason that you won't have $1 million within a year to 18 months if you actually deploy what we're suggesting you implement and take advantage of the coaching that's available to you. Everybody can do that. This is a matter of having some basic aptitudes for learning, and then letting somebody upload the information to your brain, going out and applying it. You're going to totally suck at first, just like any new skill. But if you keep applying it and allowing a coach, somebody like me, to help calibrate your understanding, calibrate your activities, you can zone in to where you get in a groove and you start making a hell of a lot of money. And then you can get little puppies like this with your money if you want, right? You could get little puppies and things if that's what you're into. Or, you could buy Stratocaster guitars or, whatever. I don't know. Whatever you want to do with your money. So that's what this is all about, is putting yourself in a position to actually be worried about, now what do I do with my cash? What do I do with the money that I have? And that's what I want to talk to you guys about. Now, we'll probably go just a little bit long today because I made a lot of notes on things, and what I can do, since it'll be hard to take screenshots. If anybody wants any of these notes, what I'll do is I'll just take pictures of these and I can send them to you. Just put notes in the comment section, and I'll make sure that you get copies of these. Although it won't be extremely easy to follow because some of these notes are actually more for me to keep the flow going here. All right, but I'm gonna rifle through this stuff here so that you can follow along with what I'm suggesting. Okay, so the first thing is this. You see, number one, it's invest in yourself. Okay, look. There is no greater investment you can make than in your own skill development. When you possess these skills and they're in your brain and you understand how to make money, and there's lots of gazillionaires who have gone broke and then made money and then gone broke and made money and then gone broke and make money. That's a very common story. They don't worry about business ventures because they have the skills to produce. So I'm not advocating for you making money and going broke, but I am advocating for you getting a fair amount of skills in your brain so that you can produce revenue anytime you want it. A lot of the time when you invest in yourself, and what I mean by invest in yourself is, look, if you have $10,000 and that's like all you have saved, and you go buy cryptocurrency, I'd say that's like the most idiotic thing you can possibly do. You have $10,000. You're basically living check to check, and you're going to invest in some speculative investment where you could lose it all. Yeah, maybe it could go way up. It has happened for people. But why wouldn't you take that money and invest in your skills so that you can earn in a very short amount of time and get to a point where you can play with your money? You're not going to lose the skills that you develop. Okay, you're way better off investing in yourself than investing in Bitcoin and some of these ridiculous gorilla monkey NFTs and whatnot, hoping to get rich off that. That's just a lottery ticket. Yeah, people win the lottery, but that's not what you want to do with your money, okay? It's not smart. Invest in your skill development. It doesn't have to be me, okay? It doesn't even have to be real estate. I'd suggest it should be, because more millionaires have been made in real estate than anywhere else. But the skills that you develop are often transferable. You learn how to be disciplined. You learn how to study. You learn how to overcome adversity and the challenges that come up in business. You learn organization. You learn planning. These are all skills that are transferable across different industries and across different ventures, and you need to get those. And if it means you got to spend $10,000, by the way, my coaching is way south of $10,000. It ought to be way more than that. But as I've described before, I'm really betting on the come. I'm betting that I can get you really good at this and we can JV later. So I make it very inexpensive to come into this program. That's also why I don't take everybody. But the point is that when you get these skills, you can go out and produce. The point was this. The point was that why would you spend your money depending on some stock to go up or some speculation to make you money instead of betting on yourself? Put that money into yourself. Put that money into yourself. Never stop growing, never stop learning, and then go out and implement. And you'll find that you make a much greater return than you will, on any of these other speculative investments, including all the ones that I'm going to talk about here today. The number one thing is to invest in yourself. Okay. So this topic that we have people in this group who have made millions of dollars. We have people, who are already sitting on, quite a lot of money. And then we have people who are, pretty much living check to check. So this first part of the presentation really is for people who don't at least have $1 million of net worth. Once you get there, which you easily can with real estate, again, it shouldn't take more than a year, 18 months. It's easier than ever to do this. with all the resources, tools that we have available, and the readily available coaching that that is available, it can definitely be done. Once you get to that point, you start saying, well, what should I do with my money? Do I want to leave it sitting in cash? No, I got to do something with it, which means you are probably going to have to make some investments, some speculations, and you could lose and you could earn. But when you don't have to use money or credit to buy real estate to drive revenue, then that's what you ought to be doing, in my view, as your day job, so to speak, right? So with that in mind, this next thing is to focus on top line revenue. Too many people are following the advice of cutting costs, cutting expenses, and they're so focused on cutting expenses. Oh, no way, I can't invest in a coaching program because I can't afford it. Look, if you have credit card, if you have friends, invest in the coaching. Yeah, that's an expense at first, but it's a worthwhile expense to take on, because you put yourself in a position where you can make multiples more than what you've invested in that expense. Okay? You have to focus your energy on growing top line revenue, and you can't grow top line revenue by cutting expenses. Okay? Because the expenses are just coming out of what you have coming in. Focus on making more money, not necessarily on what expenses you can cut out. Yeah, of course you should be careful about what you spend money on, because remember, if you go out and buy a $10,000 car, well, that $10,000 invested in some kind of vehicle in a few years could be worth a lot more. That car's not going to be worth that. If you invest $10,000 in your skill development, you could produce $1 million with that $10,000 investment. So yes, be wary of what you're spending money on, but don't lose sight of what you ought to be focused on, which is growing your top line revenue. Like I say, top line meaning like a balance sheet, the amount of money that you have coming in less the expenses that you have equals what you have left over to do whatever you're going to do with it. Okay, if you keep your top line, the revenue coming in, and you just cut expenses, you have a very limited amount of leftover that's available to you. Okay, and you compromise your quality of life. If you focus on growing the top line revenue, which means you need to get skills so that you can learn how to grow top line revenue, then you put yourself in a much better position. All right, now let's kind of start getting into the meat of this here. Like I said, I'll go a little long today probably. I'll leave this up for replay if y'all have to go though. So the next thing I have on here is has to deal with what should you focus on, right? And why real estate? So the so when you look at market capitalization, if you were to take every company globally, every single company globally, and add up its market value, right? Let's just say the valuation of the company, or if it's a public company, it's stock price times shares outstanding. That's its market capitalization. If you were to add up every company in the world, it would be way less market capitalization than the global real estate market. If you were to take every bond, and the bond market has traditionally been way bigger than the equities market. Every debt, securitized debt instrument that's out there, where a treasury bond, a corporate bond, where people are investing in that company in exchange for a promised payment of interest. If you were to add all of those up, okay, totally dwarfed by the real estate market. In fact, if you were to add the bond market and the stock market combined, it doesn't equal the market capitalization of real estate. So, and here's what those numbers are. Residential real estate globally is $250 trillion of market capitalization. Global stocks are $109 trillion. Global bonds are $123 trillion. Now this is as of June 4th, 2022. That'll change. Like the equity market capitalization has gone way up because of the tremendous. There's lots of reasons why that's occurred. Some healthy, some most not so healthy. The bond market used to be way bigger than that, but the stock market has actually caught up, to be within range of the bond market. And then something I'm going to talk about, which is gold, just to put things in perspective, extremely small. $12 trillion, right? So what did I say? 123 for bonds, 123 trillion for bonds. Gold is only, $12 trillion. And by the way, one of the tenets of the investment framework that I have for why I think now is probably a decent time to have money in gold is because the market share of gold relative to all other investments is only 0.5% against a 30-year mean of 1.5%, meaning generally asset classes like that have been around for thousands of years, there's a reversion to the mean that would occur. And if we did just revert to the mean, and oftentimes we overshoot the mean, if we just reverted to a traditional market share, you'd be looking at like a tripling of the gold price, which would mean a lot for the companies that actually mine gold. Which is one of the reasons why I speculate in that world, and I do use the term speculate because investment. I mean, it is an investment, but you can definitely lose in those markets. We don't really lose when we buy real estate because we're not using any of our own money or any of our own credit. We might lose some paper equity, but we don't actually lose any real money. Just a little bit of time, energy, resources if we make mistakes, right? So real estate, what a great place to focus that skill development. It's probably the best place to focus skill development because there's such a huge market. You just need an extremely small slice of success, in a real estate market that dwarfs everything else. Okay? And what I'd say is you have an unlimited ability for wealth creation in real estate because of what I said, that your skill sets drive the acquisition of real estate, not how much money you have, not how much credit you have. It's the skill sets that we can place in your brain over, a few months of coaching. I mean, actually, in my coaching, it's a lifetime relationship. I don't, upsell or upcharge, but go get at least a few months of coaching, and it's the skill sets that will drive the acquisition. Yeah, Travis, you weren't here at the beginning. This is actually not my pooch. I'm watching this pooch though, but he's got some separation anxiety, so trying to coddle him a little bit here. So what we do in real estate using our skills, not our money or our credit, is we create cash now. Okay, we create cash in the middle where we have cash flow, more money coming in than we have going out. So monthly we have money coming in. And then we generally set ourselves up for the potential to get cash later, meaning what we owe on a property versus what we ultimately cash the property out at in terms of sell it, there's a difference. And then that becomes more money that comes into us. So when you have all that money coming in across those different metrics, cash now, monthly cash flow, and then big paydays later on the back end of our deals, what do you do with that money? And that finally, after 27 minutes here, I'm going to get into a little bit of that. Okay, so here's the number one rule that I would say to keep in context. Okay, the number one rule is all these people that you see on Bubble Vision, CNBC, Bloomberg, whatever, all these financial market wizards, look, they don't know shit. Well, I shouldn't say that. Okay, it's not that they don't know shit, but look, they can't predict the future. Okay, they can assign probabilities to things and assign possibilities to things. They can make a valid argument for the market to go down, for the market to go up. They don't know. They don't have a crystal ball any more than you do. They might have some insights that help them, and they've been able to use those insights to generate money. So some generate money, some lose money. But nobody can really time things perfectly, so nobody knows exactly what's going to happen. And I like the Warren Buffett quote, which is that, people who predict what's going to happen in the stock market are really, I think he was talking just generally in terms of making predictions. People who make predictions, it tells you a lot about the person making the prediction and what their view is, but it doesn't tell you very much about the future. Anyway, I butchered up that quote, something fierce, so I'll give you a different one here. This is from Mark Twain, and he said, "It ain't what you don't know that gets you in trouble. It's what you know for sure that just ain't so." And you see these guys, that act like they know for sure. You see it on TikTok, with the cryptocurrencies, and you see it on Bubble Vision. They have a certain air of certainty that is completely preposterous. Okay, be careful who you listen to when it comes to speculating with your money. That's again why I like real estate, because we can buy as much real estate as we want without using our own money or our own credit. So you don't really take any risk with that. Now, from an investment framework standpoint, there's two things that I think I like to keep in mind here. In terms of what I do with my money. There's the idea of something being imminent, and there's the idea of something being inevitable. I like to invest in things that are inevitable, meaning it's going to happen at some point, and then there's sort of a hope that it'll happen more imminently because you can make more money, unless you're in an accumulation phase where maybe you don't want it to happen imminently. So I'm going to talk to you about some inevitabilities, but I don't know when it's going to happen. Meaning I will stay invested in those sectors until things play out. Okay, that's the first thing. The next thing is, in terms of an investing framework, it's always a matter of weighing possibilities versus probabilities. All right? You can invest in something that's not probable, but is possible, and know that you might lose, and you'll only have so much to lose. But if the potential gain is big enough, it's worth it. That's what the whole venture capital industry is all about. That's what, like, the biotech stuff that I work on is all about, is that you might invest in the possibility that this molecule could cure cancer, and it's probably more likely that it won't pan out, so you lose on that. But if you do that times 100 different investments, then and you find the one that does, you make an absolute fortune. So that's one end of the speculative spectrum, and then there's the probability. It's always about investing in probability. There is no investing in certainty, right? So I like to think of it in terms of this little graphic here, which is, well, it's hard to do this with the mirrored screen, but your risk of loss and your potential for gain is there with things that are possible but maybe not probable, and then that goes down a little bit based on things that are probable. So anyway, I'm just trying to set a framework for you guys here now. So let's talk about where we're at today in terms of the economy, not in terms of really an opinion on it, but some things that are just straight up factual. Okay. We are in really an economic trap right now. And by we, I really mean the people that are controlling the purse strings of, United States of America anyway. Hey, Jovan. Hey, Emil. Yep, I will do that. And I'm just watching the comments as they come in here. We're in a lot of an economic trap, right? There's clearly inflation. The inflation print is, over 8%. And I know everybody's feeling that at the pump, probably feeling that at the grocery store, probably feeling that, across the board with various things. Now, the cure for high prices, right, is high prices. If prices get so out of control and people can't afford them, it leads to a recession, and then, people go through a lot of pain, and prices begin to stabilize. The other way to fight inflation is to intentionally try to pull the economy back by raising interest rates, right? That's what Paul Volcker did in the last time we had really serious inflation in the 70s and early part of the 80s. So the idea of raising interest rates to try to fight inflation is a good one, but the problem that we have is that the inflation rate at 8%, even if it moderates and comes down to 5%, you've got to get interest rates up above 6, 7, 8% to even make it work. And if we stay at 8%, God forbid, you're going to have interest rates, up there around 9, 10, 11%. Now let's think about this for a second as it relates to real estate. Mortgages. Today, to buy the same house compared to a couple months ago, when mortgage rates were, in the 3% and now they're in the 5% range, the average payment has gone up 44%. Wages didn't go up 44%. A lot less people can afford these houses. It's an average of $800 a month more to buy the exact same median priced house. An average of $800 more per month. Just based on a small raise. Look, 5% interest. I would have been doing backflips down the hallway with glee when I started in real estate in the early 90s, being able to get a 5% loan. We were 8, 9%, I think, back then, if I remember right. So if interest rates were to go up as high as they need to be to fight inflation, you absolutely crash the stock market. You absolutely crash the housing market, and you put us into a recession. Well, maybe that's what's needed. But do we really have the appetite for that? You think Jerome Powell, the head of the Fed, has an appetite for that in an election year? You think he might get some pressure from Biden to not do that? What you're hearing about on TV about this continuous raising of rates, ain't no way that's going to happen. Now they may get away with it for the rest of the year here. Maybe they go up another 50 basis points, another 50 basis points. But the idea of getting beyond 3.5% on the Fed funds rate, and we're only at 1 right now, and look at what's happened: 20% correction in the stock market, and housing markets already starting to cool off. So ain't no way we're going to be able to really do that without really, really causing a lot of pain for people. Trashing people's 401ks, reversing the wealth effect. Now so that's one route. The other route is to pivot, like we did the last time they tried to do what. So instead of buying a bunch of bonds and mortgages like we were doing to keep interest rates down, what they're doing now is letting the purchases that they've made roll off, and they're not refinancing them. So in other words, that's called quantitative trimming. Quantitative easing is buying, 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 buying. So when you buy these bonds, it means that there's a huge demand for it, so the yield goes down, right? But when there's not as much buying, the yield has to go up because you got to attract people to buy it. So if we continue to trim, in other words, not show up in the market to buy bonds and mortgage-backed securities, the interest rates have to go up. And I just described what happens if that happens, right? If things can get pretty ugly pretty fast. So if there's a pivot and we go back to printing money, we go back, which is what I suspect is going to happen. Not going to get away with it. I don't think they have the appetite to be strong enough to push us into a recession, which is probably what's needed to fight this inflation because of all the previous money printing. Then we get into a position where, so we're going to print even more money, which created a lot of this runaway inflation. You could say it was COVID. You could say, is the supply chain shortages. I'm sure that's had, quite an impact. But it also has to do with printing trillions of dollars. And the idea of going back to doing that, well, then we run into even more inflation. And then what does that do to people's economic health? It's a trap. Okay, there's no way out. It's like that scene from A Bronx Tale. Now yous can't leave. Once you get into money printing and easing for so long, now yous can't leave. It's like the Hotel California, right? Yeah. How do you get out of it? I don't know. So it's led to this tremendous uplift of assets, houses, stocks, just about everything. Baseball cards, art, wine. It's an everything bubble. But in an environment like this, you have to ask yourself, maybe it's better to have risk off instead of risk on. We've lived in this risk on environment, cryptocurrencies, all this stuff, right? but maybe we need to have risk off. So now I'm not giving you financial advice. I'm just telling you what I'm doing and how I think about this, right? So many of you know that I've sold, quite a lot of my portfolio of houses that had a lot of equity in them because, you can see the potential for things happening and just a need to rebalance because of how much they've gone up in price. I just closed on one. I'm going to put a case study in this group. I put $700,000 of cash, effectively in the bank because I haven't allocated it yet because and I know that I'm losing money on that, right? It's like Ray Dalio says cash is trash. Well, it's not really trash, but what his point is that when inflation is going up 8%, I don't know if it's going to stick at that high of a level, but every year you're losing 8% of your purchasing power. So that's a guaranteed loss for me if I just keep it in the bank making, basically zero interest. Now I could put it in a treasury that pays 3% now, better than 1% where it was. But I'm still a negative 5%, right? The difference between inflation and what my yield is. So I'm losing 5% of my purchasing power in my cash. However, if we have a recession or further runaway inflation, or we have any kind of a crash, it gives me optionality having that cash to come in and buy things when there's blood in the streets, to buy things when they are down. One of the reasons that I've been able to make a lot of money in real estate is the tremendous amount of buying that I did after 2008 when everything crashed. And those have turned out to be tremendous investments because nobody wanted to buy back then because everybody just got clobbered and the real estate market was done and, the subprime and all that kind of stuff. So you want, and there's another Warren Buffett thing. It's be scared when everything's rosy and everything, and everything's going up, and be greedy when there's blood in the streets. So cash is a fair position to have right now, even though you have to understand that you're just paying an option premium because you're losing the purchasing power of that cash, as time goes by here. But I'm of course not sitting 100% in cash. So what I'm looking at here are really three sectors that I happen to like. Okay, gold and silver, in other words, precious metals, and then leaving a little bit of that cash so I can accumulate more. Because if we do go through a recession or a big crash, pretty much everything goes down. There isn't a really good correlation, negative correlation, even though there has been historically. If there's a crash, just about everything tends to go down, right? So that means I could get even better prices on gold and silver. I want to talk about uranium, and this has to do with inevitability that we were talking about, imminent versus inevitable, and then I'll touch about a very new commodity market called carbon credits, and why I think that's a good investment. All right, so let's talk gold and silver here. Okay, so there's really four reasons why I like the idea of being invested in gold and gold miners and silver. And at the end, I can give you, I'll talk to you a little bit about, the names and the companies because, there's some fakers and then there's, not fakers. What's the word? There's some good ones and some bad ones in, just about every industry, right? We want to choose the good ones. So one is debt and deficits. We're running at huge deficits. We're running with huge debt. Typically, in that kind of environment, it's been pretty good for gold. When you are effectively counterfeiting, meaning, if I was to go out and print money, it would be counterfeiting, but when the government goes out and effectively prints money by increasing bank reserves, in quantitative easing, it devalues the dollar by virtue of the fact that there's just a much bigger supply of them. That tends to be very good for gold. And then probably the most insidious aspect of fiat currencies is the fact that it's a negative real yield, meaning you can lend money to the government, effectively buy a treasury, and get let's say 3% yield. It's not even that, on a 10-year treasury right now, but you can get 3% on that in an environment where the government is telling you in really underestimated terms, because the CPI is kind of a BS number, is inflation is occurring at 8%. So we'll pay you 3% while you're losing 8% on the principal of your money. That's not a good investment. Okay, so think of pension funds, think of 60-40 bond portfolios, think of all of these institutions that are effectively losing the purchasing power of their money and needing to find another vehicle. Well, gold might be a way to diversify some of that money that's sitting in negative yielding bond instruments. And that is what I fully expect to occur. I don't know when, but what I fully expect to occur because of what I said earlier, that the market share for gold has really never been lower relative to every other asset class. It's like 0.5% institutional ownership, where it's normally been 1.5% over the last 30 years. So it's highly underinvested, in my view. And if anybody starts to do what they ought to as a protection or a hedge against inflation, and gold is sort of known for that, you could see a real bid in that really small market relative to everything else. It's only $12 trillion compared to these other much bigger markets: equities, bonds, real estate. Okay, so I like the idea of thinking of gold and silver as not just a potential defensive play against inflation, but something that can actually earn you money and make you money. So, I'm speculating there. The second one is uranium, right? We've got all this talk about energy, and we've got a lot of talk about clean energy, right? Going green. Now, I don't want to get into a discussion on climate change or global warming or any of that. I have my views on what's real and what isn't, but what I know is a dead certainty is the world has gone nuts over ESG, environmental social governance, and the idea that, and by nuts, I mean just there's no question that there is going to be and there is government intervention with respect to greening the world, so to speak. And that means, and not just governments, okay? There are huge goals out that probably aren't even possible. Out of that conference, I forget what it was called, but the idea that we're going to be carbon neutral, net zero, in 20 years or 30 years from now, that ain't going to happen. But we probably will do things to make strides towards that. And you cannot do that without nuclear energy. You cannot get there without nuclear energy. Can't be done. Okay? That means it's very probable that the basis for nuclear energy, which is uranium, is going to have to be produced, going to have to be mined, and going to have to be sold to energy producers. And right now, very few folks are doing that. Why? Because the price of uranium, it's up now. It's up to about between $45 and $50 now. But go back earlier this year, it was in the 20s and 30s. You can't produce uranium, a pound of uranium, for that price. So nobody's going to go out and spend $60 to get paid $45. Okay, but we have to have it if we're going to green the world, if we're going to reduce our carbon footprint, so to speak. If we're going to energize the world, you're going to have to use nuclear. So to do that, the price has to go up. It has to go up above what's called the incentive price, meaning the price to actually produce uranium. It has to go above $60. So we will see the price of uranium go up. Could it go down? Yeah, certainly. But at some point, it has to go up. And if you're invested in that, you'll participate in those spoils at some point. And if you pick the right producers of uranium, which I can share that with you, what my view is on that, then you're going to be in a good spot as well. We really don't want people to freeze and people to starve. And if you don't begin using nuclear energy, that's exactly what is going to occur. So uranium. Now, the next one is much more speculative, much earlier, but I'll explain the thesis on this. And it has to do with what are known as carbon credits. And what carbon credits are there's companies that will go out and invest in projects that sequester carbon from the environment or prevent carbon from going into the environment, or do things to enhance biodiversity, things to offset climate change. So this could be a reforestation project. There's all kinds of things that can be done, and there's an accreditation process that allows a credit to be issued for effectively offsetting a ton of carbon. And if you are Delta Airlines or JetBlue or a gold mining company or Exxon or Shell, companies that have to do things to make the world economy run, there's really no good way of getting around them not producing carbon into the environment. They can buy these credits for like reforestation projects, so they can buy these credits to offset the carbon footprint that they have so that they become net zero. So there's a huge incentive for companies to be net zero. Now, again, I'm not saying anything about the validity of climate change or any of these kinds of things. I'm just saying that it is a dead certainty that companies are going to have to go towards net zero, reduce their carbon footprint. You even see it on Amazon. You order something on Amazon, it tells you what you're contributing carbon-wise. You go book an airline, it tells you what you're contributing in terms of increasing your carbon footprint. I mean, there's a thought that people are going to individuals are going to buy carbon credits to offset their own, carbon footprint down the line. Whether that's wacko or not, it doesn't matter. It is a fact that there's a real move to reduce the carbon footprint. Now, let me explain in financial terms why I think this is a really, really great investment. Now, there's a ton of fraud in this industry, by the way, in the carbon industry, and you could understand why. So there's only a couple companies that I even look to here. So don't go just wildly investing in some ETF or something like that for carbon credits. But here's the thing. I'm just looking at Amo's message here. If you had 50K in checking, I would not put it into real estate, as I've already said. I would not put it into bonds, as I've already said. I would not put it into, the traditional types of equities. Hesitant on gold and silver since they always having ads, but historically not much yield. I don't know what you're looking at, Emil. Go back to 2000. I think gold was trading at 250. Gold, is trading, around 1800 now. I'd say that's a pretty big return on investment. So anyway, I can't answer that question for you because I don't know the entire financial situation that you had. But these are, I would be thinking gold, silver, uranium, and carbon. I wouldn't be thinking bonds, because if yields go up, right, then the value of that bond goes way down. Because why would anybody, if you have to sell your bond and it only has a 3% coupon on it and interest rates go up to 5 or 6%, you're going to lose your shirt. Well, go ahead and invest in some Cathie Wood stocks, right? ARK, and it's down 75%. When I told you that lady was full of crap, that ARK is down like 75% when she was getting all these accolades for what's going on. People asked me that same question when we did this last year, and they wanted to invest in technology and things like that. So you can be hesitant But I'd submit to you that your risk to reward ratio is way better in what I'm suggesting than anything else. But I understand, why people would be hesitant, because there is a risk in all of this. It's not as simple as real estate where we just use our skills, go out and make money. You can actually lose money in every single one of the things that I'm mentioning here. Now, but getting back to these carbon credits, Katrina, again, I'm going to say if you don't have a lot of money sitting around, this isn't like the topic. I really wouldn't be putting money into this. I'd be putting money into skill development, putting money into getting the coaching on how to make money. But yeah, I will let you know. I'll let you know which. I can just tell you right now. There's only 2 companies that I even trust in the whole space, and both of them I did with private placements before they went public. One of them is now public, and it's called Carbon Streaming Corporation. And Justin Cochran's the CEO of that company. And then there's another one called Carbon Royalty Company. But you won't be able to buy any of that second one. You could buy Carbon Streaming Corporation. You could buy it at, in my mind, probably a pretty good price. It could go down a lot further, but the price now is pretty close to what our private placement price was. So I like that one. But let me continue with the investment thesis for it. The thing that drives all business and what's driven the stock market and the housing market up is what? It's the cost of capital. You want to buy $1 million house? Well, you could get an $800,000 loan at 3-4%. You can't do that today, right? Because interest rates have gone up a little bit. They're still not high. But the cost of capital is being so low is what has spurred on so much investment. You get tremendous returns as a business when your cost of the debt that you have to take on is low, when your interest costs are very, very low. It's another reason why I say the government can't let interest rates get too high, because we have to refinance all this debt that we've created and all these deficits. And if interest rates go too high, the tax receipts that come in won't be enough to pay the interest. So that they're going to, in my mind, they're going to do a complete reversal, within the next 12 months and start printing money again. That's what I think is going to happen. We'll see. And that would be very good for gold and silver and mining companies. Now, cost of capital is what it's all about. The biggest growth in any kind of bond fund where money is pooled and then the managers of that fund go out and loan it out in exchange for an interest rate so that they can pass it on to the shareholders. The biggest growth has been in what are called ESG bonds, environmental social governance bonds, these green bonds. So much money has poured into these bonds, and these bond funds are chartered. They can only invest in companies that have some kind of a commitment towards being net zero carbon and those kinds of things. So if you are a polluting company like an airline and you want to finance operations, buy more planes, overtake Southwest or whoever, be more competitive in the marketplace, you need to get your cost of capital low. You need to get your financing costs low. So you could go out to normal lenders and pay normal rates. Or you can go where all the money has poured in to these bond funds, and these bond fund managers are looking for places to invest, companies that are willing to commit to being net zero. Whether it makes sense to be net zero or not, that the people have voted with their money. And they're saying, I only want to invest this money in companies who are going to have a net zero commitment. So if they can access money from that bond fund at, say, 3% versus 6%, from a normal lender, you've cut your interest cost way down. And if you can fund your ability to go net zero for less than that incremental cost of interest, meaning having to pay 6% versus 3%, then you're going to do it. Well, how are you going to go net zero if you're an airline? You can't really do it easily without buying these credits that are being established. This market for credits, offsets, carbon offsets. So you'll see companies go out into the market and buy offsets so that they can show, well, we produce this much carbon, but we offset it with this, which makes us net zero. Therefore, we qualify for the low interest rate on the money that we need to finance our operations going forward, to finance our growth. That's what is going to happen. That is what is inevitable. That is what is out there. And that is what I think will be the biggest growth industry going forward. And if you get in on some of these companies now and are willing to wait and deal with volatility, I think you'll be richly rewarded, independent of what happens with recessions and whatnot. So anyway, with that in mind, I got one more thing here for us, which is this, and you know what? I have a conference call coming up in 1 minute, so I better close this up quickly. I'll come back in here. And so here's what we do just to close this out, guys. People who come into my coaching program, sometimes I do get involved in these private placements. If you're an accredited investor, sometimes you don't have to be accredited. You know, we can get you into, certain things. And I'm not saying that's the reason to come into my program. I'm just saying it's kind of like one of the benefits that's out there. If you want to buy, companies in these sectors that are public, I do own some of the public companies that are out there. I like to do private placements because you can get a discount, you can get a warrant where you're offering financing directly to the company, you're negotiating directly with the company for an investment. And look, here's what I'm going to do. I don't mean to close this out so abruptly, but if you want a list of what my public portfolio looks like, and look at some of the names, because some of you are asking me in here what are the names. I'll either just post it in here or I'll message you. So just put say names or portfolio or something like that indicates to me that you'd like to see what I'm personally invested in, and then you can hold me accountable. Look at where things are a year from now or 2 years from now or 3 years from now and say, well, he was right in year one, but he sure was. He was wrong in year one, but he sure was right. Maybe 3 years from now, if this tape is still, the tape should still be up. Okay. Yeah, and I'll get that to you. So anyway, guys, I got to run. I'm actually a minute late for a call on this very topic with a company that we're looking to do a private placement with. So anyway, I'll holler at y'all later. Next week, I'm going to recap the whole program, and I hope to see y'all soon. Have a good one, folks. Appreciate you hanging with me for so long. Bye now. Have a good weekend.